Hey, what's up, guys? So today we're diving into something game-changing for crypto investors. So this is a presentation that I hosted and recorded back in August. So I wanted to give a quick 2 to 3 minute spiel, just an introduction, to give some background information. So this is a digital asset reconciliation company that uses forensic blockchain analysis to accurately track cost basis. And be sure to really listen to this because I think you'll walk away with a new understanding of crypto taxes. So tax savings optimization, and get this, the ability to amend your previous crypto tax filings for up to 3 years. So what does that mean? So for example, imagine discovering that you overpaid your taxes all the way back in 2022 and then getting that money back, whether it's 1K, 10K, or 100K. They also give an example in this presentation of saving one of their clients $300,000 in taxes by taking advantage of unrealized losses to reduce the capital gains after the sale of the client's business. So you don't want to miss this. There's really good information and tips here. I have the link right in the video description for a free consultation, and it's also right in my link tree. So this is definitely a video you want to save or bookmark for the future, especially now that crypto seems to be waking up. And just a quick disclaimer, guys, this video is for informational and educational purposes only and should not be considered financial, legal, or tax advice. So I'm not a financial advisor, and while my guest, Justin Zanardi, is a licensed CPA, the information shared in this presentation is general in nature and may not apply to your specific circumstances. So if you have any specific questions about your crypto portfolio or even looking at your previous tax filings, you can reach out to them using the link below. Anyways, let's jump right into the presentation and uncover how you could potentially reclaim thousands of dollars in overpaid taxes over the past 3 years, or just set yourself up properly for future years. So make sure to watch until the end. We have a Q&A as well. We have timestamps down below, and if the feedback is good from this one, I'm happy to have them on the channel or do a live stream. So this company is CountOnSheep. This is a done-for-you service covering any type of crypto transaction, DeFi, staking, NFTs. They prepare the IRS compliance audit-ready tax forms, and then you can just use that with your current tax professional or popular tax software. So let me introduce Justin and Nick.
Awesome. Thank you, Kevin. We appreciate you having us on. It means the world to us. And we love, having the opportunity to speak to your constituency and, talk a little bit of tax today. So we're going to dive deep. I want to introduce Justin real quick.
Yeah. Hey, I'm Justin. I'm the lead CPA here. Former Ernst & Young, turned crypto accountant. Really excited to talk about tax with y'all.
Yeah. And I'm the CEO and co-founder of CountOnSheep.
Cool. Let's get right into it. Oh, well, first quick bullet point here, we're kind of, doing this tag team with kevincage here. And as Nick said, his following. So a few bullet points about us. Kevin really gave a warm welcome, but, we're all about maximizing your tax savings. Again, this is a done for you service. And everything that we produce is going to be, IRS compliant and audit ready. We really want to make sure that, your tax forms and your transactions are ready to, withstand an IRS agent looking through them. And then lastly, as Kevin mentioned, this is keep your CPA. So, we're not trying to take you away from your current professional. We know you've been around with them for a decade. We're really just trying to do the crypto legwork on this.
Perfect. So guys, one of the big things we want to talk about today is, if you don't know already, how multifaceted, taxes are when it comes to crypto. It is completely different. When we talk to the other tax professionals that are trying to do this, they say it's like playing, a game of chess versus playing a game of 3D chess. There's just so many more moves, so many more things going on. And, there's a lot of, within those moves, there's a lot of benefits to you all. And we're gonna go through some of those today and really highlight those because, we've been kind of doing sideways summer, and Kevin's kind of alluded to this, where we're just trading sideways after, the halving. And, we haven't seen real big moves yet. And, that's getting people a little bit down. But, in our field, it's actually great. If we talk about the wealthiest people in the world, they're taking full advantage of this. And we're going to show you kind of how today.
Yep, definitely. So, just to start, we got to start with the basics. How do you calculate your, capital gain or capital loss? It's a fairly straightforward calculation. You just take your proceeds, which is the amount of cash you receive when you're selling a crypto, or the fair value of a crypto if you're swapping crypto for crypto. So that's actually a taxable event. And then you subtract out your cost basis, which is, the purchase price plus any associated fees. And so really this is the key part, that cost basis. That's the hard part to get down, to nail down. If you're swapping it between different exchanges, it's really hard to kind of track it across the blockchain. But really, that's kind of the core factor.
Right. And you guys, we're going to go through some terms today with you all, like cost basis and establishing some of these for the people that might not know. And that's really going to help out because we're going to draw out all the issues. So we really want to point out the problems right now in crypto because, your CPA might say, oh, I'll take care of you. I'll just file those 1099s for you. That's going to be a big no-no, and we're going to show you why. So understanding some of these different terms, accounting terms is going to help us out as we go.
Yep, definitely. So we're just going to run through a quick scenario here, just based on that. So to make sure we have a full understanding of how it's calculated. So you're going to, take the scenario on the left. You purchase Bitcoin for $30,000. I know it's a bit more than that at this point. And then you ultimately sell it for $35,000. But you had transaction fees of, $200 when you bought it and $250 when you sell it. So, to calculate your cost basis, you're going to take that initial purchase price of 30, and then you're going to add in the $200 for transaction fees and then the $250 for when you sold. So overall, your total cost basis is actually $30,450. And so, looking at the right there, when you get your gain, it's actually $4,550 instead of, that $5,000. So that's really a key point that a lot of people miss is they're not including their transaction fees into your cost basis. And so, you're over-reporting gains and, no one wants to do that. You're paying more in taxes. So it's really important that you're baking in all of those transaction fees back into the cost basis.
Cool. So, we don't need we don't want you to take our word for it. We want you to actually see it from Coinbase, leading exchange, where they're saying, hey, we're going to spit you out at 1099, but if any of these things have happened, it's actually kind of incorrect. So, this is from their own website. So I like to use this kind of to, really show people, that, just receiving things from your exchange, you can't take it as face value because they're already incorrect. It says, if your 1099 might not be accurate if you bought or sold digital assets on another exchange. How many of us have done that? Pretty much all of us, if we've been doing this for a while. Sent or received digital assets from non-Coinbase wallets. I mean, we all do that. Not everyone uses Coinbase. Who's to say that's the best exchange or not? Send or receive digital assets from another exchange, including Coinbase Pro. This is very interesting to highlight this one because they're saying when, even though they discontinued Coinbase Pro, but they're saying Coinbase and Coinbase Pro don't even talk to each other legitimately to share cost basis in order to give you a proper calculation for your taxes. So this is how convoluted this is, and this is how while we are for decentralization, the fact is these exchanges aren't, sharing any of this cost-based information to prepare taxes with. So that's kind of what we're getting at here. Another, interesting one to, if you've done any ICOs, they said that can be an issue. And external cold storage. I mean, how many of us use that? I do. We should be. You control your keys, right? So, with that said, if you've done any of those, if you've moved off exchange and done any of these, they're basically saying that the information that they're giving you is, not tax ready, and it will be inaccurate 1099.
Yep. And we're going to go into, an example here about why it's so important to make sure that you're tracking the cost basis from exchange to exchange, and why, Coinbase can't do that. So, hang in with me here. I know this is kind of a long example, a lot of numbers, but let's say you buy ETH for $1,000, June 30th, 2022. And then, 6 months later, right before year end, you transfer that ETH when it's worth $2,000 and you transfer that over to Gemini. So Coinbase doesn't know what you're doing. It's just going to say, oh, he disposed of that ETH. So they're going to report a short-term capital gain of $1,000 for you on your 1099. Then we go over to Gemini, and Gemini is like, hey, we got $2,000 worth of ETH. We got it on 12/31/2022. Worst case scenario, they're going to say this is actually income, and they're going to report it as income on your 1099, or even just a $0 cost basis and say you have a $2,000 capital gain. Best case scenario, they are going to just take it at fair market value and say that's the cost basis. So they say, hey, we got $2,000 worth of ETH, and then 6 months later you transfer it to Kraken when it's worth $3,000. And so again, Gemini is going to show a short-term capital gain of $1,000 for 2023. And then lastly, on Kraken, you finally sell that ETH for 3,500. A few months later, and Kraken will show a capital gain of $500. So looking here at the right, the exchanges are wrongfully showing a $1,000 gain in 2022, a $1,000 gain in 2023, and then $500 gain in 2024. And that's all going to be short term. And so the tax rate for short term capital gains is less favorable than long term. Right now, this is just, we're kind of showing the max tax rate of 37%. So you would be paying tax of about $925 for this. Whereas in reality, you didn't have tax in 2022. It was just a transfer. You didn't have a taxable event in 2023. Again, just a transfer. And then in 2024, when you finally sold it, you would only have a $2,500 capital gain. And so that would be a long-term gain taxed at, 20%. You have a total tax of $500. So, what happened here? If we were using the 1099s, one, we would be getting taxed more than we should. And two, we would be getting taxed earlier than we should. Time value of money is very important. Tax strategy is honestly not that complicated. Just defer paying tax as much as you can and accelerate, recognizing losses as much as you can. That's really tax strategy 101. So you never want to be paying your tax before it's due. And that's exactly what would be happening if you were relying on the 1099s from Coinbase, Kraken, and Gemini.
100%. And also your CPA will be like, just give me those 1099s and I'll file them for you. And then you're going to get this and you're going to pay that $925. And obviously a lot of people, I'm sure in this group as well, have a lot more commas in their crypto earnings as well, working with Kevin Cage. So, that's just something, it just magnifies how big this issue can get and how quickly it gets out of hand. And also we really want to simplify this slide by telling you what we're supposed to be doing here is wallet matching. So it's not a taxable event when you trade from your Coinbase wallet to your Gemini wallet and from your Gemini wallet to your Kraken wallet. Those are all your wallets. And when you trade from your wallets to your wallets and they're in your possession, that's not taxable. But they just are defaulting to, basically saying you sold it and it just showed up on a new exchange. And then, if you move it from there, it shows that you sold it, and you're creating these taxable events that aren't taxable or shouldn't be taxable. But if you're just to hand it off to the CPA, that's how it would go. And people are paying way too much in crypto taxes right now. So it's important to have a crypto tax prep service before the CPA.
Yeah, and just to kind of add to that, this example that I'm showing here, this was the best case scenario where they're assuming the cost basis is the fair market value at the time they receive it. But like just looking at that Gemini one, for example, they could very well assume a $0 cost basis. And then when you transferred that out, when it was worth $3,000, they would say you have a $3,000 capital gain. So you could be getting paid, you could be paying way more than what you see on the slide here. But we wanted to be conservative and just kind of show you the best case scenario here, which is still less favorable than reality.
So here we're talking about, you might have read the last slide when we're like, okay, if you're moving things off exchange and this kind of thing, there might be a few of you guys that are only using one exchange, and you stay to that exchange, you're loyal to that exchange. So you're like, Nick, Justin, we don't have those problems. I'll take that 1099 all day and I'll just file it with my CPA and we'll be done with it. Well, we got bad news for you. What the default method for CPAs and filing crypto taxes is typically FIFO, first in, first out. And that creates usually the biggest delta between your trade, which is the most taxable gain possible. So we really want to be using other models, cost-based models that we're going to go through right now that will give you more favorable results. So cost-based modeling, we were going to start highlighting that right now. And that is part of the secret sauce to really getting these taxes down in a more manageable place for you guys to make sure you're paying the least amount possible, but staying compliant.
Yep. Yeah, it's definitely key. And then for some of you there that might not know what we're talking about when we say FIFO, a quick example I like to give is, say you bought a Bitcoin today and then a Bitcoin, in a year from now, and then a few years later, you sell one of those Bitcoin. Which one did you sell? We don't know. You need a cost basis model in order to determine that. So FIFO, first in, first out, that would say you sold the first one. Whereas maybe LIFO, last in, first out, would be, hey, you sold the second Bitcoin. And why that matters is because there's a different cost basis attached to each of those Bitcoin. So that drives your gain or loss when you finally sell it. And then as Nick alluded to, FIFO is usually the most costly. The reason for that is because it's you're selling the first Bitcoin, so you probably bought that when it was nice and cheap. And so if that's the first one that's going out, you're paying the most gain. So there's pros and cons, and we'll get into that right now.
And I would just highlight, you don't have to use FIFO, and it's just the default option.
Yep.
And we'll get to why you don't want to use it.
Yeah, the 1099s, they default to FIFO, and so you're probably going to have like a less favorable tax outcome. So here's an example we kind of like to lay out. The scenario here on the left, you bought one Bitcoin for $8,000. This is, these are just easy numbers to play around with. Obviously, it's a lot more than that. But you buy one Bitcoin for $8,000 on January 15th, 2023. You bought another Bitcoin for $15,000 on March 15th, 2023. So it went up in price. And then, a few months later, on June 15th, 2023, you bought another Bitcoin for $12,000. So, we know crypto fluctuates like this. There's ups and downs. And, a lot of people are usually buying throughout. And so finally, next year you sell a Bitcoin for $18,000. And again, the question is, which one did you sell? So FIFO, first in, first out, would say we sold that first Bitcoin. So our cost basis attached to that is that $8,000. And our proceeds, stays the same as $18,000 with a gain of $10,000. And this is a long-term gain. So, comparing that to LIFO, last in, first out, it's going to determine that we sold that last Bitcoin we bought. So that $12,000 Bitcoin, the proceeds stayed the same, $18,000. We have a gain of $6,000 short term. So it's really not, it's not an easy decision. It's not one size fits all, because, on one hand, FIFO has a larger gain, but it's taxed at the long-term rates, whereas LIFO has a smaller gain, but it's taxed at short-term rates. So this is where, the analysis comes in, where a CPA or, someone making an intentional decision to review this is going to help determine what's, optimal for you. But we really wanted to call out, there is another method, and that's called specific ID. And this is a great method. And so basically what this allows us to do is this allows us to specifically go in there as a CPA. I can go into your transactions and look at all of your purchases and say, we're going to sell this Bitcoin. So I could pick that middle one right there, the $15,000 one, get the smallest possible gain, $3,000, and it actually is also in the long term because it's been held for over a year. So looking at that comparison at the bottom, FIFO has a $10,000 long-term gain, LIFO has a $6,000 short-term gain, but specific ID has a $3,000 long-term gain. So least amount of gain and long-term rates, very, very favorable. This is exactly where all the money is saved. Is having that CPA, having a professional go through and make sure that they're selecting the best possible outcome for your tax lots.
So in essence, you're able to go through and basically cherry pick,
Exactly.
like which ones make the most sense and which have the least amount of tax liability when you guys are professionally doing this.
Exactly. And one little bonus I like to add is, like, when a lot of people gift or donate crypto, one strategy that the wealthy actually deploy is using specific ID to gift the bottom of their tax lots, right? The ones that have the smallest cost basis. So it offloads that from their holdings without the tax impact. So that's really huge. I mean, obviously there's, like, if you go over a certain limit, some taxes, kick in. But some strategies that we deploy for wealthier, clients is making sure that when they gift crypto, they're pulling from the bottom rather than the top, in order to offload those from their holdings and, avoid those taxes. So there are some requirements to use specific ID, but generally, if you're working with us, you'll meet all these requirements. But in essence, this is pulled directly from the IRS crypto FAQ. But in essence, you need the date and time each asset was acquired. You need to make sure you have the cost basis and the fair market value at the time each unit was acquired. The date and time it was sold or exchanged. And then the fair market value of each unit when it was sold or exchanged. And then the other, caveat is that you have to be, tracking the cost basis on a wallet per wallet, basis. So, if you have Coinbase and if you have Kraken and you bought Bitcoin over here and you bought Bitcoin over here, you have to make sure that you can't be swapping the cost basis between the two. Like, if this Bitcoin never left Coinbase, this is, it stays on Coinbase. But of course, if you're swapping it around a lot, you can kind of start cherry picking and see, you can assign certain cost basis to different, exchanges and wallets.
So you guys, we'll talk a little bit about crypto. Some of you guys are probably thinking like, hey, I've already filed my taxes and I've used some of the DIY softwares, the Coinleys of the world, and some of the others. And they're great in some senses, in other senses they have, extreme pullbacks. So, just kind of talking about the pros, getting your wallets and exchanges in one place, I love it. They absolutely are great with APIs. It's easier to import your stuff. And really it's about getting all your wallets and all your exchanges in one place. So then you can start to do the digital asset reconciliation and matching everything up correctly. So they're good for that, for at least getting everything in one spot. For providing tax forms, after the digital asset reconciliation is complete, yes, they'll populate, and that's really nice. So that's a nice functionality. And then, they'll provide a dashboard. And, this is something that means a lot to me. I like to be able to see my dashboards and where I sit with my tax liabilities, with my crypto as a whole, and they will provide that for you as well. So I think that's the main thing is, they can, are good for onloading. They're good for providing tax forms at the end, and they will provide an ongoing dashboard for you to take a look at, just so you can see where everything's at. So I like it for organization more or less. However, they're not that great at, they're bad at wallet matching. We talked about how important wallet matching is. They can nail it sometimes, but it's not perfect. And if it's not perfect, then you're leaving money on the table. So, it's not always good at figuring out, where your wallets are, and you really have to tag those efficiently within those. And it's not always the easiest thing to do. They're also bad, when the data gets slightly complex. So if you're doing any kind of, robust trading strategies, or if you're using bots, or you're doing yield farming, you're doing different things like that, it gets confused quickly. So we want to make sure that, you typically want to rely on an expert to do that. They're bad at tax loss harvesting. They'll all say they do tax loss harvesting, but they don't really get down. It's very surface level, and it's not, anywhere near where you'd want to be if you were at, really trying to tax loss harvest to get the best, tax benefit. And then the other one would be cost-based modeling. We talked about that, and one of the cool things about cost-based modeling is what I realized about these DIY ones as well is you can, like, it will only overlay one across multiple years. So you have to do, figure out where you establish cost basis, so what year you started trading, and you have to reconcile till there and back rather. So with that said, the cost-based modeling will typically they'll just choose one size fits all. So if you don't choose FIFO, yeah, it'll allow you to choose another model, but sometimes different models in different years make better sense. So a lot of these will not allow for that, and they don't have that functionality, shockingly. So you would have to have someone, a team go in there manually and fix that to get the best outcome with cost-based modeling.
Yeah, definitely. And then I just wanted to add on, to tax loss harvesting. So the reason why we say that they're generally kind of bad at tax loss harvesting is, they'll take all of your, let's say you have, 10 ETH. They'll look at all of your ETH and then give you your average cost basis for it and say, oh, on average, you're either in a positive or negative. But, if you were buying ETH, like dollar cost averaging, for example, at various different price points, and maybe you were buying it all the way up to like $3,900, and you have maybe two of those ETH are sitting above $3,900. You can actually, we can go in there, dig into that granularity, and sell off those, that specific ETH that is above the current market price and harvest that loss, rather than just looking at the average cost basis. So if your average cost basis is below the current market price, it's going to show you are sitting at a gain. But we know that sometimes you're actually, like, some of that is above the current market price, so you could sell off off the top there and harvest those losses and still have no taxable event, or have, sorry, no taxable gain. So very important that you're getting in at that granular level to look into that.
Absolutely.
So I'm not gonna read off this slide, but there's a lot of problems with DeFi. I know most people have interacted in some degree with DeFi, Uniswap or whatever. But there are a lot of issues when you're trying to integrate or upload those transactions into Coinly or any of these other softwares and reconcile it. So things like liquidity pools, yield farming, anything like that is gonna have immense issues. The data is pretty complex. It's pretty difficult to get the data off of those, DeFi exchanges. It's really kind of, the software doesn't chew on it very well. So that's where it's super important that you have a human going through and looking at your transactions and making sure that it's fully reconciled. Most things are accounted for on the blockchain. It's a public ledger. It's very easy to kind of look it up. But the software doesn't necessarily know how to kind of put the pieces together. So DeFi, if you're on DeFi at all, I strongly encourage you to look through your transactions. It's very important, or have a professional look through your transactions, because 9 times out of 10, 99 times out of 100 rather, you're gonna be getting taxed more than you should. And then similar with NFTs. So NFTs are quite complex. One of the big problems is establishing fair market value. So it's easy when you're, maybe trading like ETH for an NFT. We can use the fair market value of ETH to determine what the fair market value of the NFT is. But to point two here, if you're swapping NFTs for NFTs, that's where it gets really tricky because you need to be using the fair market value of what you are receiving. So if we're trading baseball cards here, NFTs, and they've never been traded before, who's to say what they're valued? But the IRS is going to come after you and say, hey, what was this worth? You need to make sure you're recognizing a gain or loss based on the value. So it can get very, very complicated. One of our clients, he had over 15,000 transactions in 1 year, and he was just trading NFTs like they were baseball cards. And so, one of the instances was he had like a Bored Ape and a CryptoPunk, and he traded those two for like 13 or 15 other random NFTs. And so we had to go through, value all those other NFTs, and then fractionalize the Bored Ape and CryptoPunk to assign it to those other 15 NFTs. It was a crazy mess, but that's the level of detail that the IRS is going to force you to do. And if you're not doing it and you get audited, they will come after you hard. And then the last point here, minting NFTs, making sure that you are baking in that those costs associated with minting to those NFTs is very important, because otherwise, the NFT will have a $0 cost basis. You'll recognize 100% capital gain. We want to make sure that we are baking in as many fees as we can into that cost basis to reduce your gain.
Absolutely. So, our process is simply this. One of the first things we do is we need to get you organized. And this is what, I was looking for when I started doing my taxes years ago in crypto, and I had a 7-figure portfolio, and I needed to get everything in one place. It was completely decentralized. It was all sorts of exchanges, wallets, cold storage. So pulling that all into one frame is what we need to do. We typically look to one of our partner softwares like Coinly to help out with that. And we will help get you all set up there. It's secure, it's safe, the APIs are secure, and they're a well-backed company financially. So that's where we like to get people first. And there's also different softwares that are a little more advanced for some of our other clients, and we can always get you on those as well. So really getting everything in one place and getting you set up is part of the first step, right? And then from there, it's the stitching together your portfolio. It's chasing, it's wallet matching. It's chasing all your different trades from exchange to exchange. So this is really interesting, and this is why it's kind of the bookkeeping, if you will. But in typical accounting, bookkeepers are usually kind of at the bottom, ring of accounting, where you'll see auditors and forensic accountants at the top. Well, it's kind of switched when we do crypto and when we do digital assets. So, really we've taken people like auditors at, the top of their game, true CPAs that worked for big 4 companies, and we have them come in and help stitch this back together, because it's a lot. It's really kind of sniffing things out, using blockchain analyzer, piecing back things together, and getting it all to match up correctly. So that's really the hard part. We call that digital asset reconciliation, or DAR is the process we create around this. And this will get everything in one place where we can, start to optimize for the best tax savings.
Yeah, and that's really the bread and butter of the service here, is making sure that all the pieces are put together. I always kind of describe it as like when you load everything up into Coinly, it's kind of like taking a puzzle box and just dumping all the pieces on the table, and it's not done, it's not complete. You need someone to go in there, put the pieces together, make sure it's complete and accurate. And that's when we can kind of move on to the third step, which is maximizing your savings. So once we do that, once we make sure the puzzle is complete and accurate, it's all put together, that's when we can start doing some cost basis modeling. We kind of talked about that earlier, utilizing specific ID, utilizing HIFO or optimized HIFO. And then we can also look into tax loss harvesting opportunities. So that's where we'll dig into your current holdings. We'll look at, as I kind of talked about earlier, hey, are you sitting on anything that was above the current market price? Are you able to maybe sell that, capture that loss, and bank it so that
100%.
you can offset gains?
And I think, we can drill down a little bit more on that, because I think that's a big buzzword that we're seeing that's going across, online and in different crypto communities, is tax loss harvesting, and we're kind of seeing what does that mean, and, what can we really do with it? And, it's probably the biggest thing that we preach here at Count on Sheep is how to take an L, and sure, we're all a little bit, tired of sideways summer, as we kind of put it, where we're just trading sideways in digital assets all summer since the halving. Everybody's getting a little tired of that, I'm sure. But at the same time, now's the time to bank those losses against future gains. So I want to teach this community how to take an L. Taking a loss is great. The wealthy people love it. They're not sitting here and they're not getting upset and they're not, stomping their feet about this. They're laughing. They're absolutely okay, fine. We're going to, average down these positions and we're going to, tax loss harvest these. We're going to get out of these positions. We're going to reinvest into these positions, or we're going to, cash out and buy back in. So, that's tax loss harvesting at its finest. And it's something that you guys should all be taking a look at. If you have a bag of a certain crypto that just isn't performing, look long and hard at that and think about selling out and, and buying something else, or potentially buying back into that at a later date. Currently there isn't a wash sale rule associated with crypto because it's not a security. So, we don't have that, 30-day wait necessarily. But also, you got to be careful with the IRS, and if they see you trying to manipulate too hard, or it's very obvious, they can also take a harder look at you. So you want to balance that with some thought, but also realize that taking tax loss harvesting is used by many people. It's a strategy, and it's definitely a strategy of the wealthy, and everyone in between should be using it.
Yeah, 100%. So one of the things I see a lot in crypto, traders is this hodl mindset, which is good. If you're committed to a token or a project or something, it's good to support it. But if you take that hodl mindset to the grave, you might be sitting on thousands or hundreds of thousands of dollars of unrealized losses. It's important to consider possibly selling those losses, sitting back, reassessing the situation, and then, as Nick said, you could potentially re-enter that if you wanted to, but making sure that you at least sell those losses and benefit from it on your taxes. As Nick said,
Bank those losses in future gains.
Yep, the wealthy are utilizing their losses to still profit on their taxes, essentially, right? You want to reduce that tax bill as much as possible. We had one client who had sold his business. And in 2024, it was like $600,000 or something. And then he also had about $300,000 of unrealized losses for Hex, eHex. And so I kind of filled him in. I was like, hey man, you're sitting on about $300,000 of losses on eHex. You could sell those and reduce your capital gain from the sale of your business. So that was very important. He was thrilled to hear that. And it was a big, good, tax strategy for him.
Now he's only paying taxes on $300,000 versus $600,000.
Yep.
That's enormous. That's crazy.
Very big. And then the last step here is optimizing your tax forms and delivering them back to you. So as I mentioned, these are IRS compliant tax forms. You'll get your Schedule D, your 8949, Schedule 1, all of that. And then they will be filled out ready to file. So you could either hand them back to your CPA if you have one, or you could just plug them right into TurboTax, H&R Block, TaxAct, any of your favorite tax filing softwares. And then the last thing is we will provide you an executive summary. So a lot of clients actually really like this bit. It's a little summary kind of detailing, some of our findings, some of the specific problems we saw in your account, going over all of your income and your capital gains or losses all the way back through inception. So if you want to, take a look back at your previous filings, maybe you claimed too many gains because you were relying just on the 1099s, you can actually amend previous filings to, get back some of that money. So this is, a very good executive summary for you. You can also pass this on to your CPA if they're not really sure, what we were doing. You can just pass it on to them, and it'll kind of go over our procedure a little bit. And then we also wanted to touch on, some of the countries that we serve. So we are, we're US based and a lot of our clientele is here, but we can do just about any major nation. So as you see here, there's lots of different countries we can do. We've worked in Canada, we've worked in Australia, the UK, any major nation we're fully capable of, doing our procedures for. So we just wanted to call that out. We're not just US, we are global.
Yeah, and providing the tax forms for those countries.
Yep.
A good point is, when you guys plan ahead, you save. There's two really big tax seasons we look out for in the US. It's April 15th, which is obviously when taxes are due. And then we have extension season, which I'm sure you guys are probably listening today because you filed extensions. And so that's October 15th. And, so there's kind of these, lulls in between, a tremendous amount of people we have coming in the door. So we always try and, preach that if you get us on, in May after April, you'll be, our billable hour is far lower than it is when we start to ramp up towards these dates where, money is due to the IRS and, other states. So very, very important to keep an eye on that. And also when you're kind of looking at us, you might say like, well, what does this cost and what is this going to be? And the best way to put it is, if we're doing any kind of trading and things of that nature, and we have to go back multiple years typically to get all this done, and we have all the software, and we have the formulas and the people here to get it done very quickly for you. So it's not a ton of billable hours, but it takes a little time. But that's also where we find all the tax savings that we can push forward as well. So very important to realize that. And then when they said, okay, well, what does this usually cost? And I usually say, when I look at the books, we're typically between 0.88 ETH, so like a 0.8 ETH, and maybe 2 ETH if you're very complicated scenario, is what you'd look to get this done the first year, and then it's quite a bit less after that. Maybe a few hours build, for next year. And then then there's also people that come to us that are pretty new to crypto and just started trading last year or this year. And it might be like my mom who has 5 ETH, and it's all on Coinbase. So I mean, we can set those up and fix those really, for a flat rate, and it's typically under $1,000. And we get it all done, and we load you up on the platform, get you a license and everything else for that, and now you're ready to go. And a lot of this will keep tracking throughout the year and keep pulling in your information throughout the year as well.
Yeah, and I just wanted to add to that. You brought up a good point. So when we're onboarding clients for the first time, we have to reconcile all the way back through inception to your first trade. It's the only way to accurately track cost basis. It's the only way to do our modeling and make sure we're optimizing your taxes. And so that takes the the most time. That's what we call the archaeological dig. But after that, then it's just a really simple update each year. And so what I always tell people is it's really good to work with us if you're a first-time client in those lull seasons. That's when it's going to take the most time, but it's very, very important that that gets done so that we can optimize your taxes moving forward. And even retrospectively, as I mentioned, if we find major savings, it's important to consider amending previous returns so that you can, get some money back. So yeah, best times to work with us as a first-time client would be, summertime, and then like, November, December, right around the end of the year. Mid-January to late January, we're going to start picking up again as we approach that April 15th deadline.
And I would also say it's not too late to work with us now. I think
Not at all.
Kevin got us on at a great time. We're still ramping till October 15th, and there's still room, and we still have, low billable right now as well. So, please take advantage.
Yep. And that's it. Count on us, count on sheep. That's what we like to say. Thank you
Yeah.
guys for the presentation. We're going to do Q&A now. So if anyone has any questions, specifically about crypto, or any examples you want me to walk through, I'm happy to answer those.
I just want to say I was kind of in and out, but caught most of it. That was really intriguing stuff, guys. These are like questions that I haven't known the real answer to for a pretty significant length of time. So to hear you guys dial in to, FIFO, LIFO, and Spec ID, super interesting. I definitely see the value in what you guys are doing here. Look forward to working with you.
Oh man, we
Yeah.
really appreciate you.
It's super important. I mean, honestly, the IRS is fairly, and they don't give a lot of guidance to crypto, and they've been kind of neglecting it purposely, I would say. So, as a professional, we have to, really dig deep into what we know about property, because that's how the IRS, classifies crypto. So we can apply what we know about property to crypto. Of course, the IRS has like the crypto FAQ, which is where they talk about Spec ID, and the requirements that you must meet in order to use it. But really, Spec ID is so powerful. It's very important to be using that instead of just applying FIFO, because you're really going to miss out on a lot of tax savings for that.
I'm just curious how it relates to assets where instead of having one, you buy like, millions at a time. Is it something where you're like looking at the blockchain explorer for that specific asset to target?
So, I mean, are you referring to like dollar cost averaging, or are you saying like you buy, a million tokens at once?
Yeah, like certain assets that have a higher token supply, instead of like one Bitcoin, instead of having like 20 Bitcoin in my portfolio, there's like, I don't know, 3 million Casper bought at various stages
Yeah.
of time at various prices. And I didn't do the greatest job keeping track of stuff like that, just because it's gone from one exchange to the other, buying where I can. They shut exchanges down, things like that.
Yeah, definitely. I mean, I was working on a account before this who had 7 trillion tokens. It was like some weird meme token. But yeah, 7 trillion. And it was just like that, he was buying various chunks at different times. So we will load in, all of your data, and it'll usually via API. So any wallet addresses, we just need the public key, and that can just automatically sync to, most of these softwares. For exchanges like Coinbase or Kraken, you basically can load that in too. So most of this can be loaded in via API, and it's going to automatically pull in all of those transactions. And then we can see the lot at which you buy. So, maybe he bought 1 trillion here, 2 trillion here, 1 million here. We can kind of see all of those different tax lots. And that's where we kind of start to pick and choose which ones are, optimal for him to, be, selling from.
That's awesome.
I had a question. So that was really interesting related to the amend previous filings for any tax savings. How far back can you go? Just the previous tax year?
That's a great question. It's 3 tax years, yeah. And that's also for, for anyone that didn't know, that's the IRS statute of limitations, for basically saying, hey, you owe more money. It's 3 years. So if it's past 3 years, they can't reach back that far. But yeah, some quick facts there.
Like if it was 2021 trading year, but then it was filed in 22, can you go all the way back to that filing year, or is it? Or
Yeah,
am I understanding right? Okay.
Yeah, it's 3 years from when you file. So as soon as you file your 2024 April 15th, then 3 years before that drops off. The filing 3 years before that drops off. That makes
Okay.
sense.
Yeah, I thought that was interesting with the exchange tax data example of just sending ETH a few times between different exchanges. And it's been crazy the past few years because I'm a US resident and I know everybody can relate. We've been kicked off KuCoin, MEXC, BitGet. So I'm getting that Palau digital ID to attempt a KYC on some of these exchanges. But just sending between all these exchanges, I imagine that example you had with Ethereum of $500 versus $900 plus in liability, that's an 80% increase, which is crazy.
Yep.
So like imagine people that are trading or own 20 assets, prices are moving and you're flip-flopping everywhere. That's a big deal. I mean, that could be the difference of 30K in taxes versus 20K with 16 grand in savings. So I love that.
Yeah,
You nailed it.
and to add on to that, I mean, the 80% increase, yeah, that's one thing. But then the other is you're paying tax before you need to. You're paying tax at times that you shouldn't be. And then we've even seen it's very common for, especially Coinbase to just assign a $0 cost basis. So I mentioned that example was best case scenario. A lot of times these exchanges will assign a $0 cost basis. So you could be paying triple, quadruple the amount of tax you should be.
Yeah, that's wild. I know sometimes even a 10% reduction in taxes sounds nice, but wow.
Yeah, we have clients that they're getting maybe audited by the IRS, and they're looking at their 1099s from Coinbase, and it's saying like, oh, you have 100% capital gains. And they're like, I know I only lost money. I know I didn't make 120K this year. I probably lost 30K. And so they're freaking out because they're like, what? I don't owe money. I know I just lost money, and the exact reason is because Coinbase and these other exchanges, every time they're getting in new funds, they go, I don't know where this came from. So on the 1099, I'm just going to report $0 cost basis. So whenever they sell it, it's 100% capital gain.
Insult to injury.
Exactly. So the way that you get around that is, the IRS is, here's what the IRS is doing. They're looking at the 1099s that they get from Coinbase, and then they're looking at you, the taxpayer, and saying, what did you report? If you didn't report anything, they're just going to use the 1099s, which are, way unfavorable. But if you're reporting a reconciled account, you've gone through this, you have all the correct tax forms, you have all the data to back it, the IRS will just use what you report to them because they know that the 1099s from Coinbase might not have all the information. But if you fail to report anything, then the IRS will say, all right, we'll just use the 1099 from Coinbase, pay up, guilty until proven innocent is what the IRS basically does for taxpayers.
Sounds like we're good. Guys, I just want to point out one last thing. We just want to say thank you so much to Kevin Cage and having us on, today and allowing us to be on the Discord channel. We really appreciate you. We also want to make sure you guys for, sitting through there and, going through that huge tax lesson today. We want to reward you guys as well. So, you come and talk to us for free. You can go to our website, CountOnSheep.com. And you can, see Justin. You can scroll down on the homepage, see Justin on there. book a time with them. We're glad to talk to you guys as long as you want about your portfolios and, and help you kind of, create a game plan on what you want to do. So yeah, once again, very happy that you had us on. We appreciate all you.
Yeah, thank you so much.
Yeah,
That was
thank you,
super
guys.
informative.
Awesome.
All right. Thank you, everyone. Bye.
Thanks, guys.
See you,
Take
fellas.
care.
Appreciate it.